Hello and welcome back to the show. The subject of today's episode is why are so many of us feeling not just the pinch but the squeeze these days? There has definitely been a massive tightening of belts that's had to be done over the last few years. And for a lot of people who are working really hard and having to, balance their books even more so in the last few years, it can be hard to understand exactly what's been going on. So today we're going to stare some very cold, hard facts right in the face and see exactly what's going on in our world that is creating this squeeze. Now, normally, as you know, I'm very upbeat, but there are some times that you need to just be real and look things straight on rather than bury your head in the sand and pretend that everything is okay. And today is just one of those times. So we're all facing massive changes in our world, particularly on the financial sense. So I thought it was a high time that we sort of delved into the economic climate, and whether we like it or not, we are all being faced with these challenges. We are all being impacted. So I feel it's at least better to be informed and forewarned so that you can see how best to navigate these ever-changing times. So here are a few interesting facts and figures for you. Now, we all have heard that there has been pretty high inflation over the last few years, certainly since 2020, since the COVID years. And the impact of inflation in real terms is actually a double whammy, because not only has your pound become worth less, or your dollar, or your yen, or whichever currency, your euro, whichever currency you are working with in the world, not only has that become worth less in the last 4 years, prices have been soaring as well. So in the UK, the statistics are that the pound has gone down by around 20 to 25% in value over the last 4 years because of inflation. So that means that your purchasing power of your pound coin has gone down 25%. So something that you could have bought for £1, you can now only, it's worth, it's 75p. Not only has your pound gone down in value, things have become more expensive by X amount. I mean, if you only have to look at your energy bills or your petrol fuel consumption, your food consumption, insurances, everyday costs of living have gone up extortionately in the last 4 years. Supply and demand has been impacted, and it's just put that massive squeeze. So not only is your pound becoming worth less, your costs are increasing. So you're getting this double whammy effect, which is creating that sort of big squeeze really on our own personal finances, right? So you've got to ask yourself, why is this going on? Especially because there are plenty of big companies that are making billions still. So particularly the one that really gets me is the energy companies, and they're walking away with billions of pounds in profit, yet they're saying that they've had to put prices up because they're being squeezed by the oil companies or the gas suppliers or what have you, and yet they're still making billions. It just doesn't make sense, and we've got to kind of it just gets my goats that it doesn't seem to add up, perhaps. The only good thing, in my opinion, from my point of view, as to why inflation is a good thing, is that if you have a level of debt, that debt actually decreases proportionately too, which is great for people who have mortgages or low-cost loans, because the mortgage amount stays the same or goes down if you're paying it off regularly on a repayment basis. However, because the pound is becoming worth less, that debt is gradually being eroded. And this is really highlighted with the impact of house price inflation as well over the course of time. So if you buy a property such as we did, the very first buy-to-let property we bought for £46,000, and we had an 85% loan-to-value mortgage. I've spoken about this on a previous podcast, and therefore the 85% loan-to-value mortgage, I can't remember, it was around about 37,000, maybe a little bit more, and now that property is worth 150,000, 160,000. Proportionately, the level of debt on it is significantly lower. Proportionately, so it's now only, what's that, 25, maybe 20% loan to value, something around that sort of figure. So proportionately, the loan has gone down, but also it's, £37,000 now compared to when we bought it 20 years ago seems like nothing, right? And so that's what I mean by the level of debt appears in real terms to go down. So that's actually really positive, and which is why we've always been massive advocates of being involved in property. But anyway, I digress. Rolling back to the economy, rolling back to the economic climate. What happens if there's the risk of the economy sort of blowing over when interest rates have been kind of cut as far as they can, and the country is just at a bit of a standstill economically speaking? What happens is that the banks decide all of a sudden to have quantitative easing, and this has become a real thing in recent years, hasn't it? That they just decide to create more money supply. And it is literally that. It is literally plucking money out of the air, out of the ether. It's not backed by anything. The gold standard was kicked into touch back in the 1970s completely. So therefore, it's a really funny old system. There's a great series actually called The Hidden Secrets of Money on YouTube by Mike Maloney, which you may want to go and check out, about that whole history, money and the economy and currency, and what is real money and real currency, how that all works. It's a great series to go and watch. But what's interesting is when it hits a bit of a stalled patch, if you like, is that this quantitative easing happens. So they create more money, which stimulates the economy because banks have more to lend out. There's more money flowing around, etc., etc. And so the official line is, and this is taking it directly from the Bank of England, similar to a cut in bank rate, quantitative easing seeks to lower interest rates, thereby stimulating demand by reducing borrowing costs for households and corporates, supporting asset prices, and putting downward pressure on the exchange rate. Sounds fantastic, doesn't it? Amazing. Let's just pluck money out of the air and put it into the economy and think it's going to be a great thing. But what actually happens is that it devalues our currencies because there is so much more supply. So when it's like a dilution of the value of the currency that we hold in our bank accounts or in asset terms. And that is, in part, is why our money is becoming worth less. The value of money is being eroded and eroded. So moving on to debt to GDP ratio, GDP being gross domestic product of a country. This is quite an interesting fact. So the UK currently, compared to its gross domestic product, is 100% in debt. So our national debt is equivalent to our GDP. I mean, that's insane. Absolutely bonkers. Most of Europe is around 80%. I think on average across Europe, it's about 80% in debt compared to its GDP. The US is about 125% in debt. And Japan has a crazy figure of 260% in debt versus its GDP, which is just insane. But again, interestingly, and because we are at this point in time where this has never before, well, as far as I understand it, it's unprecedented times. What happens, interestingly, because we've all seen that interest rates have kind of risen very rapidly over recent years, over the last sort of since 2022, 23, they really ramped up here in the UK and the US. And every time governments borrow more money, the debt needs to be refinanced every sort of 3 to 5 years. So what happens is that it creates a cycle of rates going up, and then when they need to refinance, the rates come back down again because they cannot afford to refinance at the higher level of interest rates. So it's very interesting starting to watch this cyclical effect of interest rates going up and down. It's like creates this sort of bell curve, if you like. And so if you do have borrowing, such as we have a very high level of borrowing, and every property investor that I know who has a decent portfolio has high levels of borrowing, you have to watch these interest rates really carefully, because the idea is that you can refinance when the rates have gone down. This is the same if you have a decent level of mortgage on your own home as well. You want to seek to refinance when that level of interest has come down. So it's great to be able to kind of keep an eye on how they play with the economy, how they play with the interest rates, and sort of get in tune. And rather than be fearful of rates going up or grateful for rates coming down, just see it as a bit of a game and see that they do this to, for their benefit, not for our benefit, for their benefit, but we can turn that to our advantage. And when we see or we know that the rates are going to be coming back down, that's when we can choose to refinance onto a much lower level of interest rate for as long as we possibly can. We've had some amazing interest rates over the years when rates have come down, particularly after the credit crunch of 2008. Rates came absolutely tumbling down. We were able to fix on some very decent long-term low-level rates, which in turn brings up the cash flow. And of course, when rates go up and you're having to refinance, that cuts the amount of cash flow that you have in a property portfolio. So we have to keep a very close eye on this. Now, we're all at the mercy of these things. So it's just a question of boxing clever and sort of thinking, okay, well, interest rates have climbed. They've reached a bit of a peak in compared to the last few decades. And so we're now seeing them start to tail off. Okay, we're heading into the last quarter of 2024 right now, and they're starting to tail back down again. And I think we're going to be, if you're coming up to a time to refinance, it's an interesting time to think, well, could I maybe only refinance onto another fixed rate for a year or two to see them come down even further before fixing onto a longer period of time, let's say 5 years. All these types of questions are relevant if you're facing that point at which you're having to refinance your own home or any investment properties that you own or any other debt that you have that you need to service. Okay, a culmination of all these things, including taxes, and goodness knows what's going to happen in the autumn budget for us here in the UK. That's going to be an interesting one to watch. Taxes may well be hugely impacted. And this is why we're all feeling not just the pinch, but the squeeze in real terms. A little bit of a potted history on what's going on in terms of the last few years. I'm going to release another episode next week, which is all about house price inflation and how that we have quite an interesting view here in the UK about house price inflation and how this works in relation to the wider economy, and how we all sit in this little bubble of, well, house prices always go up in the end. But in real terms, we need to really take stock and think, is that true? Or are our house prices being artificially inflated, and are they actually going up in real terms? So I will release an episode on that next week so we can have time to delve deeper into that. So anyway, this was just a few little bits and pieces for you to kind of contemplate, and I'm not saying that there's anything that we can do about them on a large scale, but just being aware of what happens, what takes place in the market from a wider perspective is really, really, really important, because then you can make the best, most conscientious decisions for your own personal situation and learn how to navigate these markets. So If you would like to know more about how to work with the market, not against it, how to benefit yourself rather than being at the mercy of these kinds of markets, then feel free to be in touch with me via the Contact Us page on the freedomclub.com website, which is the-freedom-club.com website, the link to which is on this page. I look forward to helping you if I can, and I'll see you on the next episode.